showing more context behind the descriptions. So disposable income, it includes net income, the paycheck, and after-tax income. So it includes all three of these, and they make up what would be disposable income. So usually disposable income is equal to your before tax income minus taxes. That's usually how they calculate it. So it's mostly just after tax income. And you can spend this on goods and services. So that leads to after tax income is then spent on goods and services. And this has a multiplier effect on the economy. So consumption spending has a multiplier effect on the economy. So like a multiplier effect is basically the return you get on each dollar of spending. So let's say you spend $1. Let's say you spend, $100 investing in an infrastructure project. Let's say it's like 10,000, let's say, because that looks more realistic for infrastructure. And the project produces 20,000 in value. To get the multiplier in this case would be 20,000 divided by 10,000. So like equals 2. So for every dollar spent, $2 are created. So the multiplier is 2. So it shows the return you get on investment. The multiplier is basically return on investment. So that's why the multiplier is important, because it shows you if something's worth spending on. The government uses that a lot to determine if something is worthwhile. So the spending on infrastructure has the highest multiplier. So like highest return on investment is spending on infrastructure. And that'd be like roads, public transit. Let's say like roads, public transit, buildings, highest return on investment. So they use the multiplier to determine if something is worth investing in. It should be greater than 1. So like if the multiplier is less than 1, they are losing money on the investment. Yeah, if it's greater than 1, they're making money on their investment. So that's very important that they are making a return.
So were you sad for a long time?
In that case, so making a return is really important in this case. So I'm just gonna snapshot this. So those are the 3 things that would. So I sent that to everyone. We'll just erase this here. So one of the multipliers that they use is the marginal propensity to consume. So it's the fraction of any change in disposable income that is consumed. So to calculate it, you do change in consumption divided by change in disposable income. So let's say you in this case, let's say your spending on consumption goes from 200 to 300 when your disposable income goes from 1,000 to 2,000, let's say. So to calculate that, you would do 200 minus 300 divided by 1,000 minus 2,000. That would just be negative 100 divided by negative 1,000, and that would be 0.10. So that would be the multiplier here. So the MPC, the marginal propensity to consume, is 0.10. So that is pretty low. So pretty low. So they don't consume that much. They don't consume a lot more with higher incomes. Like their consumption stays pretty small regardless. Their consumption stays pretty low regardless of income. So that's really what this shows us here. Yeah, that's really what the MPC shows us here. And that's the interpretation, like what we see like out of that is really what is important. The calculation is important as you go farther in economics, but the interpretation, like if you find out that it's pretty low, they don't consume a lot more with higher incomes, their consumption stays pretty low regardless of income, that interpretation there is what is needed for this course. The calculation is definitely more as you go along with economics. So I'm really looking at the interpretation here. That's really what is important to this course. So marginal propensity to save is the fraction of any change in disposable income that is saved. So it's the change in savings divided by the change in disposable income. So in this case, like let's say so in the last example, disposable income increases from 1,000 to 2,000. Consumption only increases from 100 to 200. No, wait, it was 200 to 300. Yeah, 200 to 300. So let's say the saving increases from 800 to 1,700, let's say, because we save the rest that we don't consume. So to get that, it would be 1,700 is 2,000 minus 300, and then 800 is the 1,000 minus 200. So let's say we do that here.
Is there a parameter like for MPC, it's 1, for MPS, should it be 1 as well, or it's not as straightforward?
So for this, to get MPC, there's a few ways to get MPS. We can use this formula here. This formula is one way. And also we can do MPS would equal 1 minus MPC.
Yeah, I mean, like,
Yep.
Is there a standard? Because you said that MPC, if it's above 1, you're making profit. If it's below, you're losing money. For MPC, is there such a characteristic?
Oh, so I for that I should have expanded on that. That's for when I said about the like for the, if the multiplier is greater than 1, you're making profit. And if the multiplier is less than 1, you are making a loss. I should have clarified that those multipliers are investment multipliers.
Okay, sounds
So
good.
sorry about not clarifying that.
No, that's
These,
okay. I may have misunderstood. Thank you.
oh yeah, like you were right. I should have clarified that these are spending and saving ones. But we'll get to the investment ones down the road. Sorry about that.
Sounds good.
So here, if we calculate this here, let's say we want to do the saving. So we do 800 minus 1700 divided by 1000 minus 2000. So we do the change in savings divided by the change in income, disposable income. So this would be negative 900 divided by negative 1000. That would be just 0.9. So that's the MPS here. And this is the same MPS as we would get if we did MPS equals 1 minus MPC. Because the MPC for this example was 0.10, like we got from last time, from doing it in the last slide. So this is how we did it here. So this would equal 0.1 here. So that's what we got from the last slide here. And then if we did that, we're 1 minus 0.10, we get 0.9. So both calculations, if we calculate MPS with either formula, we would get the same result. So like either way, if we use either one of these formulas, we'll get the same result. So like I said before, this all we need for this course is the interpretation. So the 0.9 here basically means, so our MPS is 0.9. We save 90% of like our change in disposable income, basically. And then we save 10%. No, we spend 10% of our change in disposable income with a marginal propensity to consume of 0.1. So yeah, this like I said, this is all we really need to know for the course, like just the interpretation of this. Like that's really the what is needed. But like I said, if you go further in economics, you will have to calculate it. But this is for this course, we just need to know the interpretation. And also for making good decisions, like economic decisions in work and everything, the interpretation is really the most important thing. Yeah, I really think that out of anything, the interpretation is the most important. So knowing what this stuff means, which is basically what this course is more important than doing these calculations. So I'll put this in chat here. So marginal propensities. MPC plus MPS equals 1. So marginal propensity to consume equals 1 minus marginal propensity to save. Marginal propensity to save equals 1 minus marginal propensity to consume. So remember, people do two things with the disposable income: consume it or save it. So it all has to come together. Like they're not doing anything else with it. They're either consuming or saving it. So that's why it's only both of them together. So yeah, so people only do two things with their income: consume it or save it. Yeah. And the spending multiplier effect. So thanks for bringing up, Alexandra. This is where the spending multiplier comes up. So this one can be more than one. This one can be more than one. But the MPC and the MPS, they can only equal one. But this one can be more than one. So this basically shows the return on investment for consumption, investment, government spending, and exports. So it shows the type of return you get on increasing that. So it shows if it's a good investment, if the multiplier here is greater than 1, you will get a return on investment. And then if the multiplier is less than 1, the multiplier is less than 1, you will make a loss on your investment. So the government uses multipliers to determine what projects to invest in. So that's a very important measure that they use all the time to determine if they're going to invest in something. So if there is a government program out there, it's likely that they think that the multiplier is more than 1. So why does this happen? Expenditures and income flow continuously. So this leads to spending increase in the economy. So if the government increases defense spending by $1 billion, then defense contractors will hire and pay more workers, which will increase aggregate spending by more than the original $1 billion. So in this case, since the aggregate demand increases by more than the government spending, the multiplier is positive. The government makes a return on investment. So that's key here. So this example is good because it clearly shows the multiplier is positive. So if you're a government employee in this case, you will likely approve this because it will lead to more benefits than the investment was. So that's one of the ways the government makes decisions. So calculating the spending multiplier. Spending multiplier can be calculated from the MPC or MPS. So in this case, you do 1 divided by 1 minus MPC or 1 divided by MPS. So multipliers are positive when there's an increase in spending and negative when there's a decrease in this case. So when the government taxes, the multiplier works in reverse. So why? Because money is leaving the circular flow. So the tax multiplier, this is kind of beyond the scope, but yeah, don't worry about this at all. If there's a tax cut, the multiplier is positive because there's now more money in the circular flow. So assume US citizens spend 90 cents for every extra dollar they earn. Further assume that the real interest rate decreases, causing a $50 billion increase in gross private investment. Calculate the effect of a $50 billion increase in investment on US aggregate demand AD. So calculate the MPC and MPS. So in this case, the MPC would be 0.9, because if they're spending 90 cents, they spend 90 cents for every dollar, you would just do 0.9 divided by 1. They're spending 90 cents for every extra dollar. So like that would be 0.90 divided by 1. And then the rest of it, they're saving. So they would be saving, saving 10 cents for every extra dollar. Because the rest of the dollar, the 10 cents left over would have to be saved, because either consumed or saved. So yeah, 90 cents is spent, 10 cents is saved. And then the spending multiplier, we would do 1 divided by marginal propensity to save equals the spending multiplier. And then that would be 1 divided by 0.10. That would just be 10. And then calculate the change in aggregate demand, like $50 billion investment times the spending multiplier of 10. So $500 billion. So here, with an increase of 50 billion in investment, aggregate demands will increase by $500 billion. So it's a worthwhile investment in this case. So in this case, they are making 450 billion return on investment. This is a big return for the 50 billion initial investment. The government will likely approve this. So yeah, economists at the government of Canada, they're doing calculations like this constantly. And these types of, if there is a multiplier like that, and if you're going to make $500 billion off of a $50 billion investment, they're going to say yes, likely. Yeah, likely they will, unless it's missed and they didn't do the calculation. So that's yeah. So in that case, that's a great investment. That'd be very good for the economy in this case. So I'll take a snapshot of this and send it. So like I said before, this thing I'll select here. This is really what I'm focusing on here. These types of descriptions. The math here is just more on how it gets there, how you get here. But this is really the scope of the course. The 50 billion investment leads to $500 billion aggregate demand increase. So that's really what we're looking at in this course. So in this case, assume Germany raises taxes on its citizens by 200 billion euros. Furthermore, assume that Germans save 25% of the change in the disposable income. Calculate the effect of 200 billion euro change in taxes on the German economy. So the MPS is 0.25 because they save 25% of their income. So you just put that in the decimal form right here. And then this would be just subtracting 1 minus 0.25. So yeah, MPC equals 1 minus 0.25. So they would say, so they would spend, Germans assume, so Germans in this case spend 75% of their change in disposable income. So then in this case, they use the tax multiplier. So they would do the negative MPC divided by MPS, and that would be negative 0.75 divided by 0.25, that'd be negative 3. So you would do the 200 billion euros times negative 3 equals negative 600 billion euros change in aggregate demand. So for that, the interpretation of this is that it's a raise in taxes. So if taxes go up by 200 billion euros in Germany, aggregate demands will go down by 600 billion euros. So that makes sense because there's less, there's less they can produce. They can produce slash, so in this case, they can spend less because they have to pay more taxes. So aggregate demand will go down. Aggregate demand will go down because consumption goes down. So that makes sense. Like we showed that on the aggregate demand graph when it shifts left. So aggregate demand would shift left. So yeah, if you did this as a graph, aggregate demand would shift left. So that makes sense there. If taxes go up, the aggregate demand will shift left. Yeah, generally, yeah. So that's a good example there. This could be shown just with curves too. Like if you did an aggregate demand and aggregate supply curve on a graph, you could just show what happens with a tax increase to aggregate demand. And then this one here. So I also posted this under February, this day's submodule on Financial Online. So this PowerPoint's available on there for use after. So assume the Japanese spend 4/5 of the disposable income. Furthermore, assume that the Japanese government increases its spending by 50 trillion yen in order to maintain a balanced budget, simultaneously increase taxes by 50 trillion yen. Calculate the effect of 50 trillion yen change in government spending, 50 trillion change in taxes on Japanese aggregate demand. So 4/5 MPC, because they spend 4/5 of disposable income, that would just be 0.8. And then the rest would be 0.2 for MPS, marginal parentheses save. So there's an increase in government spending and an increase in taxes. So we combine a positive spending with a negative tax multiplier. So in this case, we do 1 divided by the MPS of 0.2 equals 5 for the spending multiplier. And then the tax multiplier, we would do MPC, negative MPC divided by MPS, and we would just get negative 0.8 divided by 0.2 equals negative 4. And then we would do the change in government spending times the spending multiplier plus the change in taxes times the tax multiplier. And then we add them together. So in this case, based on the government spending the government spending effect is greater than the tax effect. So the economy grows in this case because the positive change in aggregate demand due to the increase in spending is 250 trillion yen, and the decrease in and the increase in taxes leading to a decrease in aggregate demand is only worth 200 trillion yen. So there is a net increase in aggregate demand of 50 trillion yen. So yeah, so that's so in this case the economy grows. So yeah, so in this case the government spending would provide more growth than the tax increase leading to losses. So that was a complicated example. It won't get that complicated on the assessments, don't worry. So the balanced budget multiplier, that one was a difficult one, that question. But when the government spending increases are matched with an equal increase in taxes, the change so the change gets canceled out here. So the balance